Hi, with all the market volatility we've experienced, I wanted to send a quick video out on how best to handle market declines. There's been more market fluctuations in the past 3 months than we've seen in the past 3 years combined. There are many reasons why we're seeing the volatility, from fears of an all-out trade war with China, rising interest rates, the drop in the price of oil, or are we just at the end of a bull market cycle? The volatility is definitely emotionally taxing, but should we let it influence our investment decisions? The worst thing we can do is make a short-term change now to our investments that could impact us hitting a long-term goal. So the first slide I wanted to show is that market declines don't last forever. And in fact, they're actually normal. From 1900 to 2017, there's been a downturn of 5% in the market or more on average about 3 times a year. There's been a 10% drop on average once a year. There's been a 15% drop about once every 2 years. And there's been a 20% or more drop once every 3.75 years. Now, no doubt these drops are emotionally taxing because when you're going through it, it feels like the market will never recover. But it always has recovered. The second row in this table shows that the average time that it takes to hit a low. And obviously, the bigger the drop, the longer it takes, but the market does come back. And in fact, what it really is time in the market is what matters. And market timing is extremely difficult, if not impossible. So this slide shows that missing just a few of the best days in the market can really hurt your investment returns. Here we look at a hypothetical investment in the S&P 500 over a period of 10 years from 2002 to 2012. So it's a good sample set because it includes the market crash we saw in 2008 and 2009. Now, if we don't take dividends into account, if you would have just left your money in the market over that 10-year period, you would have had an annual average return of 6.4%. And that's where you see that $10,000 turns into the $18,558. However, if you would have missed just the best 5 days of the market over those 10 years, you would have missed out on 72.9% of the return. And you would have been left with $12,315. If you would have missed out on the 10 best days in those 10 years, you would have actually lost money over the time. And you can see it even gets worse if you would have missed the best 20, 30, or 40 days of the market. So again, it's not the trying to time things. It's really being in the market is really how you can benefit from investing. So this slide shows that emotional investing can be hazardous, and we're all have the ability to succumb to emotional investing, and it's inevitable that it will come into play. Right when the markets go up, we become confident and we want to add money to our portfolio and take on more risk. And then it's natural when the markets decline, we become fearful and want to sell or withdraw our money from our portfolio. When in fact, we should be doing the exact opposite. By rebalancing our accounts periodically, we're forced to sell things that have appreciated and are at their highest and purchase investments where there's value. Warren Buffett said it best. And what he said was, investments are the only thing that investors refuse to buy when they're at their cheapest and only want to buy when they're at their most expensive. So it makes sense to have a plan and stick with it. I'm a fan of automating your investing. And if you contribute periodically to your portfolio, you will participate in dollar cost averaging. This means that if the price of your investments go down, the next time you add money to your portfolio, you'll be able to purchase more shares of them. So, and this strategy goes back to purchasing when prices are on sale and how that's a good thing. So if you look, no asset class has consistently offered the best returns year in and year out. So because of that, I'm also a proponent of diversification between different asset classes. Over the past 10 years, you can see that there's a change almost every year in which asset class does the best. U.S. large cap stocks have had a good run over the past years. But it doesn't mean that going forward, they will be the best asset class. From 2000 to 2010, there wasn't much upward movement in U.S. large cap stocks. But if you would have had an international stocks and particularly emerging markets allocation in your portfolio, you would have actually had pretty good returns over that period. So it's important to really diversify amongst the different asset classes on both the stock and the fixed income side. Really, the approach that I like to take is really a risk approach. And it's important to know how much risk you currently have in your portfolio, how much risk you're comfortable taking so that you do not make one of those short-term emotional investment decisions that can hurt you long-term. and then also how much risk you should be taking with your investments. And by aligning those three metrics, you can turn yourself into a successful investor and set yourself up for success with achieving your goals. So I do offer a free tool on my website that anyone can use where they can take an assessment of the risk that they're comfortable with and the risk that they're currently taking and just make sure that they're aligned. And then from there, you can look and see how much risk you should be taking with your portfolio to hit your goals. And anyone has the ability to use that. And if anyone has any questions on their portfolio, what's in it, or how much exposure they have to what's going on to the markets, I'd be happy to talk. And you can find my contact information from my website.